Pricing Strategies and Methods for Retailers. Management 330 by Eileen Salazar. The basic premise of a successful business operation is selling a good or service for more than it costs to produce or provide. The difference between the cost of a product or service and its selling price is called markup. Markup can be expressed in dollars or as a percentage of either cost or selling price. The cost of merchandise used in computing markup includes not only the wholesale price of the merchandise, but also any other costs. Markups vary across industries, but in the fashion clothing business, a markup of 140% is common. Once entrepreneurs create a financial plan, including sales estimates and anticipated expenses, they can compute their company's initial markup. The initial markup is the average markup required on all merchandise to cover the cost of the items, all incidental expenses, and reasonable profit. While operating expenses include the cost of doing business, such as rent, utilities, depreciation, and reductions include employer and customer discounts, markdowns, special rates, and the cost of stockouts. Once an entrepreneur determines the initial percentage markup, he or she can compute the appropriate retail price using the following formula. Pricing concepts for manufacturers. For manufacturers, the pricing decision requires the support of accurate, timely accounting records. The most commonly used pricing technique for manufacturers is cost-plus pricing. Using this method, a manufacturer establishes a price that is composed of direct materials, direct labor, factory overhead, selling and administrative costs, plus a desired profit margin. The main advantage of cost-plus pricing is its simplicity. Given the proper cost accounting data, computing a product's final selling price is relatively easy. In addition, because they add a profit onto the top of their company's costs, manufacturers are likely to achieve their desired profit margins. The traditional method of product costing is called absorption costing, because all manufacturing and overhead costs are absorbed into a finished product's total cost. This absorption costing includes direct materials, direct labor, plus a portion of fixed and variable factory overhead in each unit manufactured. A more useful technique for managerial decision-making is variable costing, in which the cost of the products manufactured include only those costs that vary directly with the quantity produced. In other words, variable costing encompasses direct materials, direct labor, and factory overhead costs that vary with the level of the company's output of finished goods. When variable costs are subtracted from total revenues, the result is the manufacturer's contribution margin, which is the amount remaining that contributes to covering fixed expenses and earning a profit. Expressing this contribution margin as a percentage of total revenue yields the company's contribution percentage. Computing the contribution percentage is a critical step in establishing prices through the direct costing method. Computing the break-even point selling price. The manufacturer's contribution percentage tells what portion of total revenues remains after covering variable costs to contribute toward meeting fixed expenses and earning a profit. Suppose that this manufacturer's variable costs include the following: material, direct labor, variable factory overhead. The minimum price at which the manufacturer would sell the item, for example, would be for $6.98. Any price below this would not cover variable costs. Pricing strategies and methods for service firms. Service businesses must establish their prices on the basis of the materials used to provide the service, the labor employed, and allowance for overhead and profit. Most service firms base their prices on an hourly rate, usually the actual number of hours required to perform the service. For most firms, labor and materials make up the largest portion of the cost of service. To establish a reasonable, profitable price for service, small business owners must know the cost of materials, direct labor, and overhead for each unit of service they provide. Here's an example of a direct cost income statement for Ned's computer repair shop. You can take a look at his sales revenue minus his variable expenses, which include labor, materials, and a variable factory overhead. You can also include his fixed expenses, which would be rent, salaries, and a fixed overhead. In this particular case, the net income for Ned's computer repair shop would only be $27,000. Here's an example of how to compute a direct labor rate. The example includes the time that it would take to produce one apron. You would factor in the machine setup time, which would be about 15 minutes, machine downtime, another 15 minutes, 2 mandatory paid breaks per day, which it would be 30 minutes. In this case, it takes 2 hours and 10 minutes to produce one apron. To arrive at the total direct labor cost, you would multiply the amount of time it takes to make one unit by the employee's hourly rate, which would include payroll tax and benefit costs. The impact of credit on pricing. Consumers crave convenience when they shop, and one of the most common conveniences they demand is the ability to purchase goods and services on credit. Small businesses that fail to offer credit to consumers lose sales to competitors who do. Small companies have 3 options for selling to customers on credit: credit cards, installment credit, and trade credit. Consumers in the United States hold 1.4 billion credit cards. In fact, the average credit card holder in the United States has 7 cards. Shoppers use credit cards to make 20 billion transactions a year that account for 2.4 trillion worth of goods and services annually, more than 76,000 in sales per second. The average shopper uses a credit card 119 times per year and charges an average of $88 in goods and services. The message is clear. Customers expect to make purchases with credit cards, and small companies that fail to accept credit cards run the risk of losing sales to competitors who do. Companies that accept credit cards incur additional expenses for offering this convenience. Businesses must pay to use the system, typically 1.6% of the total credit card charge, which they must factor into prices of their products or services. They also pay a transaction fee of 5 to 25 cents per charge. The average fee is 10 cents per transaction. Given customer expectations, small businesses cannot afford to drop major cards, even when credit card companies raise the fees that merchants must pay. Fees operate on a multi-step process. On a typical $100 credit card purchase that a customer makes, the bank that issued the customer's card receives $1.80, an amount that consists of about a 1.70% processing fee. This fee is called the interchange fee. It is the fee that banks collect from retailers whenever customers use a credit or debit card to pay for a purchase, and it usually includes a 10-cent flat transaction fee. Credit card processing, commonly known as swipe fees, costs merchants $50 billion per year, and small businesses typically pay a higher credit card processing fee that their larger companies do not. you can see an example 1 of how the credit card process is for customers who go to retailers or manufacturers and use their credit card. It averages, you know, the $1.80. The interchange fee is pretty much a set fee. And I think that about wraps up my presentation. Thank you very much.